Today, we're discussing a big story in the world of international taxation and trade. Switzerland has suspended India's most favored nation or the MFN status under the Double Taxation Avoidance Agreement. This decision comes on the heels of a crucial Supreme Court ruling in India concerning the Nestle case. Let's break down what this means for the economies of both the nations. First off, let us understand what is the MFN clause. The Most Favored Nation clause is a key feature in international agreements. It ensures that any favorable terms granted to one nation are extended to others with similar treaties. Essentially, it is like a VIP pass to the world of international trade, as it ensures that a country gets the best possible deal. For India and Switzerland, this meant lower tax rates on dividends, about 5% for the qualifying companies. But all that's about to change. This started with a Nestle case in 2021 when the Delhi High Court supported the use of the MFN clause, allowing reduced tax rates under the India-Switzerland Treaty. However, this all changed in October 2023 when the Indian Supreme Court reversed its decision, stating that the MFN clause couldn't be applied automatically without a notification under India's Income Tax Act. This in turn created a disagreement between the two nations on how the clause should work. In response, Switzerland has suspended India's MFN status now. Starting January 1st, 2025, dividends earned by Indian entities in Switzerland will be taxed at 10% instead of 5%. The Swiss government has cited the lack of reciprocity in the treaty's application for this decision. So what does this mean for Switzerland and India relations? Well, the immediate impact includes higher tax liabilities for the Indian companies operating in Switzerland. This could make investment commitments under the European Free Trade Association or the EFTA agreement less appealing too. And what is the EFTA? It is a trade agreement that was signed in March this year between India and the 4 European countries, namely Norway, Switzerland, Iceland and Liechtenstein. Under the deal, the European group is expected to make investments worth $100 billion in India over a period of 15 years. The agreement, though, is yet to come into effect, and the recent decision could play havoc with the trade agreement plans. Let's not forget India and Switzerland have a strong economic relationship. In fact, in 2023, their bilateral trade exceeded $30 billion, with India exporting pharmaceuticals, textiles and IT services to Switzerland, while importing machinery, chemicals and luxury goods. While Swiss investments in sectors like manufacturing and finance have been crucial for India's growth. Experts though believe the suspension reflects a larger trend in global taxation, with countries asserting stricter treaty interpretations to protect their domestic revenues. It also underscores the need for clear and mutually agreed terms in international agreements. Meanwhile, India's Ministry of External Affairs has hinted at renegotiating the treaty to better align with the trade commitments. In conclusion, Switzerland's decision highlights the complexities of international taxation and trade dynamics. And while businesses face immediate challenges, the future really depends on how these countries navigate this critical moment.